Hey, welcome to Retire Mentorship. My name is Freeman Lindy. I'm a certified financial planner and licensed tax expert, and I help folks over 55 mostly to make that transition from from working into retirement. And author a couple of books. One that's about to come out, and one that's been out for a while. And let's get right into the topics today. So we're trying to keep on the theme of taxes for this tax season, and in honor of my new book, Tax Saving Strategies, which is coming out. If you are watching live, you can drop comments or questions in the chat, and we'll have a Q&A at the end of the episode where we will answer some of those questions. And if no one asks any questions in the chat, you can always email questions in to questions@retirementorship.com, and we will answer those. Should be a link in the description too if you want to hyperlink, click that and watch that. So let's jump right into the main topic of today, which is tax efficient charitable gifting strategies, right? What are three ways that we can give tax efficiently if we are trying to give some of our money away? And some of you might be thinking, I'm not trying to give any of my money away. I don't need to give any of my money away. Well, real quick, right? Giving by definition means you don't need to, right? If you need to give, if you need to send money to someone, it means that you owe them wages or taxes, right? So that means you owe them, right? If it's a gift, then by definition you don't need to, right? So yeah, you don't need to give. But for a lot of my clients, they were diligent savers for many years. They've accumulated a great nest egg. They can't necessarily turn off the savings and like the frugality bug, right? They've been keeping their expenses reasonable, saving a lot, and they can't necessarily just flip that switch into spending more in retirement, even if they need to. And so for a lot of people, it's, hey, they're going to pass away with more than they started with in retirement. And so if they're going to give all that away at the end, because you can't take it with you, what if you wanted to give some of it ahead of time? And so we wanted to say, if we're going to give money, then how do we also save taxes while doing it? So those are the things that we want to cover today. So I talk about a few more extra gifting strategies in here. And so you can get the book if you want all of them. But for now, we're just going to cover three. And before I jump into that, real quick, a big common misconception is, hey, how can I give tax efficiently to my kids? Where most people want to get, hey, they're all going to get in the end. Should I give some of it early to them? And it's kind of a big misconception, but here's one way to think about it, right? First of all, there's you probably know the annual gifting limits, right? For 2026, it was actually the same as it was in 2025. You're allowed to give $19,000 a year to your kids or grandkids or anyone else, right? That means, right, so this is you, and you've got your child or grandchild, right? You can give them $19,000 a year. And if you're married, your spouse and maybe their other parent can also give them $19,000 a year. And if your kid is married, you can give them $19,000 a year. And your spouse, maybe their other parent-in-law, can also give them $19,000 a year. So that's, what is that, $76,000 that you can give to, if you are a couple, to a child couple. And then if you have multiple kids, you can do all that. And so that's the annual gift limit exclusion. And people have a lot of misconceptions around this. Really what it comes down to, right, is you can exclude, when you finally pass away, I think you can exclude something like 15 million each. The number keeps changing. I forgot to look it up. I think it's like $15 million. And so again, for both of you, that means $30 million, and you can exclude that from your estate. And so only the amount, right, over that. So you have the first $30 million you would get to exclude entirely, and only if you have more than 30 million would you pay estate taxes on that amount. And so what this is doing is saying, hey, each year then you can give $19,000 each to each person, and that does not count against this exclusion, this lifetime exclusion. If you give more than that, let's say you decided not to do any of this and you just gave $20,000 instead, just to one person. What that means is that, hey, that extra $1,000 above the gift tax exclusion, that's going to count against this. And so now when you finally pass away, now you can only give $2,999,000 and exclude that from your estate tax. So really, even this doesn't actually matter that much. You do have to file like a gift tax return and keep track of that and all these other things if you do go over the exclusions. So usually we recommend that people don't do that. But it's not as big of a deal as people think. but you can't get a deduction. You can't give directly out of your IRA. You can't do any of these things by giving money to kids. The only thing you can do if you're trying to give to kids and grandkids is, let's say that you bought something like a stock or something in a non-retirement account. And let's say you paid $1,000 for it, right? And so you've paid $1,000. That's called your cost basis. This is actually a really important term to know for taxes. And over time, right, that has grown with the stock market or whatever else, and now it's worth $3,000. Right? This here, this $2,000, 300,000, no, just 30, grab that, 3,000. This $2,000 is your capital gain. So if you sold it, you would owe capital gains tax on that $2,000 there, right? The $1,000 you paid for it is always going to be excluded. And so if you sold it, you could pay capital gains on that $2,000 and then give them the whole $3,000 after. Or if you want, you can gift to your child a stock. But if you gift it to them, they're going to still have the original cost basis. So you give it to them at $3,000, it's still as if they bought it $4,000. Why might you do this? Well, you might be in a 15% capital gains tax bracket, and they might be in a 0% capital gains tax bracket. So that's about the one time you can tax efficiently give money to kids or grandkids, is if they're in a lower capital gains bracket, you have appreciated stock, and you want to give them that appreciated stock. So if you're going to give them $3,000 anyway, instead of giving that to out of their checking account, you might as well just give them a $1,000 stock that is appreciated to $3,000. And then at least that way you're not paying that taxes on it, makes it their problem, and it might not be a problem for them. So that's kind of an aside, not really a charitable gifting strategy, but a lot of people question that or have questions around that, and so wanted to at least hit that for them. Okay, so we're going to get some new paper here and hit the next one. So the first charitable gifting strategy that we actually want to cover is going to be qualified charitable distributions, right? And hold on one second, let's get a little more space. There we go. Okay, so with qualified charitable distributions, if you had an IRA, right, that means that you haven't paid any taxes on it, right? It's pre-tax for the most part. See if I can't, there we go. You know, you've got your IRAs, you put money in there, pre-tax, it grows, tax deferred. When you pull it out, you pay those taxes, right? And so, you know, you've had all this account, it's grown pretty big, you're trying to give money away. One of the things that you can do then is, once you are over 70 and a half years old, and they really do need you to be over the half. Instead, what you can do is you can give directly out of your IRA to your church or charity and pay no taxes on it. So normally you pay taxes, but in this case, you're doing a qualified charitable distribution, which is going to, you know, it doesn't go to you. It's not made out in your name. It goes straight into the name of the charity and goes straight to them. And then you would pay no taxes. So for instance, if you were trying to give $1,000 to your church, for example, you could, you know, pull money out of an IRA. You could pull, let's say you were in a 25% tax rate bracket, right? So you could pull whatever that would be. This is not going to be the right math because I can't reverse engineer that math in my head. But you have to pull something like $1,300 out, right? And then you'd pay 25% taxes on that. And so that would give you the $1,000 you would need to send to your church. Or instead, you can just give either $1,000 straight out of your IRA to your church, and then they would get the same, but you would get to save the same $3,000. Or you can send the $1,300 that you would have pulled out anyway to your church, and then it's the same amount out of your IRA either way, so there's no impact to you, but the church gets 30% more, right? Either way, the IRS, you know, gets kicked out of that equation. And so if you're over 70 and a half, or you're going to be soon, this is an excellent way for you to say, hey, I'm going to shift whatever I'm giving to charity. If I'm giving through my Social Security check or any of these other things, you'd want to stop doing that and instead plan to give all your IRA or all your charitable gifts directly out of your IRAs, right? Obviously, if you have a complex enough situation, there might be some reason not to do this. But for most people, if you give charitably, doing it this way is the most efficient way to do it, because you're just literally saving all your taxes. And then for most people, right, when they're hitting 73 or 75, they're doing the required minimum distributions, which is where, hey, you haven't paid any taxes on this account up till now. We're going to force you to take money out of that account so that you pay the taxes. Well, yes, you can pull the money out and just pay all the taxes, or you can send them to charity a QCD satisfies your required minimum distribution, right? Things like conversions don't, but a QCD does. And you're like, why the different ages? Well, your RMD age used to be 70 and a half. They moved that up to 72. First it was 72, and then it was 73/75, depending when you were born. And so that all got moved, but they forgot to move the QCD age with it. So that's still set in stone at 70 and a half. So it's great you can do it sooner. So definitely something to be aware of if you're in that age range. And if you're not in that age range yet, you're like, well, that doesn't help me at all because I can't do that for a long time. No problem. We've got a couple more strategies for you. So with this one, I didn't want to have to write out all these numbers. What do I do with them? Here we go. So I just printed some stuff here. That way we can get through this quicker. So let me clear a little bit more space just so we don't have all that stuff in the background. But let's say that you give regularly or irregularly to charities, and you're just saying, hey, how can I cut the IRS out of this? Right? We don't want the IRS in this, and we want to give more or give the same amount and have it affect us less. Either way, I think is fine. So what this comes down to is a concept called deduction bundling. It's not just for giving away charitably, but it really helps if you're including it with your charitable giving. So the way that it works, right, is when you're doing your taxes, you can take either an itemized or a standard deduction, right? For 2026, the standard deduction is, or this is 2025, 2026. 32,200 is the standard deduction. So you need your itemized deductions to be more than this number for you to itemize instead of taking a standard. Otherwise, you just take the standard, right? Itemized deductions consist of your health expenses that are over your AGI, your adjusted gross income, right? And that's hard to do, right? Because your adjusted gross income might be, $100,000. So that means, it's not over that. I forgot to put this in there. 7.5% of your AGI. There we go. Forgot to put that in there. So that means if you have $100,000 of AGI, you would have to spend more than 7,500 in health expenses. So only the amount over that. It's not, hey, if you clear it, then you can deduct all of it. It's only the amount over 7.5. And most people's max out of pockets is less than 7.5% of their AGI. So this one, really hard to do. Ooh, excuse me. So then it comes up with these other things, right? So you have state income taxes, property taxes, mortgage interest, charitable giving, right? If all of these, and we're just going to exclude this one because almost no one can do it. If all of these equal to total itemizable deductions, if that's more than your standard deduction, then you would take the itemized deduction, right? Now, in the past, your state income tax and your property taxes, that was known as SALT, state and local taxes. And that used to be capped at $10,000. So if these two together were more than 10,000, 10,000 is the max you could take. So then it was 10,000 plus these two would give you your total itemized deductions. But with the new laws, the One Big Beautiful Bill Act that came out in July of last year, that SALT or that cap is now 40,000, unless you make a ton of money, then it actually comes down. But you could be like over $500,000 a year for that to qualify. So that really increased, which opened up this strategy to a lot more people. And that's why it is kind of new for 2025, but it's a whole new strategy for 2026 for a lot more people. So let's take an example here. Let's say that in year 1 and 2, in year 1, we have 0 health insurance or health costs above 7.5% of our AGI, because again, that's really hard to hit. So 0 for each year. Let's say your state income tax is $7,000 per year, and that just doesn't change year over year for some reason. Your property taxes are $5,000 this year, and then they're going to go up, right? Property taxes go up. So let's say it's $5,200 next year. Let's say your mortgage interest was $6,000. That's probably going to come down because as you're paying down your mortgage interest goes down as well. And then let's say that you give $1,000 a month to charity. So $12,000 per year, right? So then in each year, for let's say this year and next year, your total itemizable deductions are $30,000, right? This goes up and this goes down. So we just make it nice, easy math. The standard deduction for 2026, let's say this is 26 and 2027, is 32,200, right? This is bigger. So we're just going to take the standard deduction, right? Which means that we did have $30,000 in expenses that technically are itemizable, but we didn't take any of that, right? And so we wasted $30,000 in itemizable deductions, right? And then we go the next year, we do all that stuff, right? Same thing, $30,000 in deductions. Let's say the standard deduction goes up to $33,000. We don't know what it's going to be for that year, but that's probably close enough. So again, you're going to take the standard deduction and you're going to waste $30,000 in deductions again, right? So we don't want to do that. So this would be the strategy. This is where you would bundle. You just say, again, same thing, none. We're going to pay our property tax. You can't do anything with that. But for some people, right, at least here where I live in Wisconsin, this may or may not be true for you. But here's one aspect of it. Let's say, so we go over the course of a year. So we got January to December, and then January to December, right, etc. And for us here where we live, right, so we got December over here, we get our property tax bills for the next year in December. And then they're due January and July. And then you get another one in December, and they're due January and July. Or you can pay them all up front or whatever. But that's how that works here. So what we would say is, hey, if you got your bill last December and you are just going to pay it normally here, go ahead and do that, right? So you paid, if it's whatever, $7,000 of property tax or $6,000 one year, right? Then we're going to say, okay, go ahead and pay your $3,000 and your $3,000. But then when you get this, or there you go, sorry, $2,500, $2.5. When you get your next property tax bill, and that's $5,200, go ahead and pay that $5,200 in December when you get the bill. So then you've doubled up, right? You've paid this property tax bill and this one inside the same calendar year, right? Now, you're not going to be able to, you're going to have nothing for these ones. So you're not going to pay anything in that one, and you'll get another tax bill here. But then you could do it again in the next year, right? And so basically what you're going to do is you're going to double up property taxes. So you would say, hey, instead of paying $5,000 and then $5,200, we're going to just pay $10,200 in 1 year and pay nothing the next year, right? And then same mortgage interest, we can't pay that off any faster. But then same thing, if we're giving $1,000 a month to our church, we say, hey, we're going to give that all the way along monthly, right? And then in December, we're going to say, hey, church, going to give you an extra $12,000. I'm going to give you all of next year's tithing upfront here in December, or whatever charity you give to. Give it all. Don't spend it all at once because you're not getting anything next year, right? This is not extra. This is all of next year. It's this year. They don't care. If they manage it well, they can spread that out, right? They don't pay taxes, so they don't need to get money in 1 year and like, oh, well, hey, if we realize all this income in 1 year, we're going to pay more tax. Like, none of that matters to them. And so they don't matter. It'd be helpful for them to get up early. They just can't spend it all. So you let them know that. And instead of paying $12,000 each year, you pay nothing next year and you pay $24,000 this year, right? That means that your total itemizable deductions are now $47,200, which that is now bigger than your standard deduction. And so we waste zero expenses. We actually get to itemize them all and take a $47,000 itemized deduction that year, right? Then the next year, we have two things that we pay nothing on. So we're not going to have that at all. So the next year, we have $12,800 of itemized. And so we just go back to taking the standard, right? And the way that this works then is, if this is the standard deduction, and these are different years, we can say, hey, we're going to go over the standard deduction 1 year and then back under it. And either way, we can get higher deductions in 1 year. And the worst we're going to do, though, is get the standard the next year, right? And then we're going to go and we can do it again the next year. And we basically, if we wanted to, we could do every other year of itemized standard. And with that, then, if we look at some results of this, over 2 years, your regular standard deductions would have been $65,000. But because we bundled them over 2 years, you were going to be deducting $80,000. So it's about $15,000 more if you're at 22% federal, 5% state, right? It's about $4,000 a year. If you do that every other year over 10 years, that's $20,000 in tax savings. Now, some of this, there's some things that we have to claim some of this back, and you might miss out on a couple other things. So it's probably not going to be a total net savings of $20,000. You can see what your local state tax situation is or whatever else. This is kind of the upper limit of what you could get with this. And again, if your tax rates are higher, you'll be more. If your tax rates are lower, it'll be less. But definitely worth doing because again, you are just saving. Let's say it is this, or let's say it's half of this. Let's say it's $10,000 after all the clawbacks and whatever else, right? But the only thing that you did with that is you just moved when you paid things, right? You're not paying any more expenses to get this. You're just shuffling around when you pay the exact same things and save $10,000 to $20,000. So That doesn't suck. And so with deduction bundling, then it's the same thing, right? You can save this tax, which means if you want, you could give more, because you're like, hey, well, if I'm saving all these taxes, right? If I'm able to save $4,000 or even $3,000 this year, I could give an extra $2,000, which would mean that we're, and still save $1,000. So we can give more and have less of an impact, or we can just save that then. And either way, like, hey, we're giving anyway. How can we do it more efficiently? Well, that's one way that you can do it more tax efficiently. So QCDs, if you're over 7.5, still probably the most effective way to do that. And if you're not there yet, then deduction bundling might be a great way to do that. And you might say, well, hey, I don't, I'm doing the math on my own stuff, and I don't know that I either have enough of other expenses. Maybe I can't do that with my property taxes, whatever else. And you might be saying, hey, I don't know if I can come up with enough charitable giving to be able to qualify for that. And so what else can I do? Well, that brings us to our last strategy here, which is to donate appreciated stock, right? And so obviously we'd have to have some of that to do this one too, but same thing, right? Let's say you bought a stock for $10,000, right? It has now grown quite a bit. And so you were so again, this is your cost basis. Definitely want to know that term. Cost basis always means what did you pay for it? And usually you can always get your cost basis back tax-free, right? And so if this grows to $20,000, same thing with the child gifting, right? You paid 10 for it. It's worth 20. This gain right here, this $10,000 is your capital gain. If you sell this, you pay taxes on this, right? But here's the thing. You can say, hey, I'm going to instead give $20,000. I'm going to give the appreciated stock worth $20,000 to charity because I didn't sell it. I don't pay the $10,000 in taxes. They get it. They get the original cost basis as well. Anytime you gift stock, the original cost basis goes with it. But since you're gifting it to a charity, charities don't pay taxes, so they can sell it and they just pay nothing on this capital gain, right? But here's the other. So you don't pay the capital gains. You don't pay that, and neither does a charity. But here's the other cool thing, right? Then that $20,000 can be used to itemize. So maybe same thing, right? You might say, well, hey, I don't give enough of that, but you could do the same thing. Well, hey, if you do give enough over a few years, where you could say, hey, I'm gonna pull 5 years of giving into 1 year, just so I can do this one time. I'm not going to try to do every other year, but like, hey, I'm going to be giving this anyways. Why don't I do this and just be really generous 1 year and then, just make up for it over the next few years. Either way, you're saving taxes, they're saving taxes, and because then you can take that $20,000, mix it with the other stuff, and itemize and save not only the capital gains, but also on the deduction side, the itemized deduction side. And if you're doing bigger numbers, right? If you throw a 0 on there, even more, right? And so for a lot of people, this becomes a great way where, hey, if you're going to give anyways, are there ways you can combine, do all these different things to give more efficiently? The other thing with that, right? You're like, well, hey, I'm kind of curious. I actually do have some stock that's appreciated quite a bit. I don't know that I want to give $200,000 in a year, though. That seems excessive. Perfect. That's where donor advised funds come in. Like Schwab's got one, donor giving DF 360. DF Giving 360 or something, Fidelity, Charitable. So if you have stuff at Fidelity, at Schwab, probably at Vanguard too, although I can't remember if they have one. What you can do is you can basically say, hey, I'm going to put money into this account. It's for charity. So once you've done that, you can't get it back out. It is already committed to charity, right? But you can do the same thing where you can say, hey, I'm going to give that $200,000. I'm going to put that into a donor advised fund to give to charity, right? Again, I pay no capital gains, so I still avoid that. I can now take a $200,000, in this case, itemized deduction all at once. So that would be really easy to itemize for, right? And so you're going to write that off against your regular income. And then instead, if you normally give, $2,000 a year, or $10,000 a year, whatever, you would just each year give out of your donor advised fund, right? So, hey, I'm going to give this amount total over the next 10 years anyway. Why don't I just do it all at once so I can get an itemized deduction, and then I'll get the same 1/10 of it each year over the next 10 years, right? So if you're committed to giving, right, what are some ways we can do it strategically where we just save some taxes? And that would be a great way to do it. And so bundling things together, doing it all at once, paying out of certain accounts, not others. Again, a lot of people, they have brokerage accounts, they have things that are appreciated, and yet they still give out of income instead. and there might still be some reasons to do that, but it might be like, hey, maybe every year you should be giving out appreciated stock instead, right? And in some ways, again, if you're trying to, hey, I want to give the same amount, but I want it to cost me less. Okay, well, what if you put $10,000 into an account each year, let that grow for a few years, and then gave, the $12,000 it grew to instead of the $10,000 you put in, right? So there's ways to maximize these things. Or you split the difference, right? I'm going to give less. More is going to go to the charity and less out of my pocket, and I'm going to split that difference with the charity. Give them a little bit more, and I keep a little bit more as well. So there's just some really efficient ways that we can do this if you want to be creative and forward thinking and do some of the work. And if you don't want to do the work, but you're like, that sounds like a great idea, why isn't my advisor talk to me about this? Bingo. And if I'm your advisor and I haven't talked to you about this, maybe it's because I don't know you give. And we should talk about that because that'd be fun. So yeah, those are some great ways to give more efficiently. There's a couple other things in this book here. Again, tax saving strategies. That is going live for pre-sale tomorrow, I think. You can pre-order on our website. There's a bunch of goodies on there that you can get if you pre-order the book. Otherwise, you'll be able to pre-order on Amazon starting tomorrow. And then it comes out 4 weeks from tomorrow on March 26th. So lots of good stuff on there. Make sure to check that out in the description. And now it is time for some Q&A time. What do we have, producer Ethan, for our first question of the day? Okay. Ken wants to know, why do fees vary so much among financial advisors? It seems like yours are on the high side. Okay. I like the last part. Hold on. Okay. So I don't know if I have anything to illustrate for this, but just in case, I want to be ready. Okay. Why do fees vary so much among advisors? That's a good question. So what do you pay? Actually, I talked about this. We'll use this one. I talked about this somewhere in this book here. I can't remember where. What do you pay for a hotel? Depends on where you stay and what you get, right? Right. Hotels are a commodity, but not, right? Because there's different tiers of things. So here's one way to think about it. This is kind of what I talk about in here. If I were to say, hey, I've got an all expenses paid trip to somewhere, and I can't go, so I'll sell it to you for $5,000. That's the price, right? Is that a good deal? So price equals $5,000. Is that a good deal? Well, it depends, right? Depends on what? Well, depends on what is the value that you're getting for that price. If I said, okay, the hotel is in Delano, Nebraska. It is Spirit Airlines flying you there. It's a Motel 6, and you're on your own for all your own food and entertainment. Well, I probably couldn't pay you $5,000 to go to Delano, Nebraska, stay at a Motel 6, and pay for all your own stuff, let alone charge you $5,000, right? That's me offloading a bad deal onto you. So that's going to be out. What if I said, okay, it's JetBlue business class or first class tickets to the Ritz-Carlton on Lake Tahoe. All food is included, including a drink voucher, ticket, unlimited, whatever. I just can't go, and I'm trying to get rid of it. Well, the value of that is, I don't know, $20,000, $30,000. I don't know how much that would be, but that would be a steal, and you would definitely pay $5,000 for that, right? Clear your schedule. That sounds awesome. So price, I think Warren Buffett said this, right? Good old Warren Buffett, Uncle Buffett here. Price is what you pay, value is what you get, right? So the reason that fees vary so much amongst advisors is because value varies so much among advisors. Part of it is that there are other fees stacked on to some advisors. They've got different middlemen. They've got them, custodian, broker dealer, insurance product manufacturers, all these things. So there's lots of fees layered in there. And so the fee is on the high side and the value isn't quite there, right? I don't mind paying fees if the value is there. But you shouldn't pay fees for value that's not there, right? And so it's not necessarily just that the highest fee is the most valuable, but there tends to be some correlation there, right? And so to your last point about yours seem to be on the high side. Well, high side of what, right? Realtors charge 6% to sell your house. Okay. Annuities cost 4% per year. A lot of them, 3%, 4%, somewhere in there. The standard advisor fee is 1% to just manage your assets. And then you can dial a CFP or whatever else for maybe, I don't know, 0.25% at Vanguard. I don't know what they charge now, but it's all right. There's a whole range of fees. What are you getting for all this? Right. And the way that I always like to think about it is you should go for whatever's going to give you the highest value. And for a lot of people, they're trying to get, they're optimizing for the ratio of price to value. How can I get this to be the highest multiple? And I think that's wrong. I think you should go for whatever is the highest value, obviously over and above what you pay, right? You could pay for, if it was $200,000 of value, but you paid $190,000 for it. Well, that doesn't mean, right? So we're talking net value because it's only $10,000 net value, right? But so like this one here, 5,000, like that's a $15,000 net value. Okay, so let's break this down in this corner up here. So let's say you have two options. 1, 2. You could, I'm trying to just do this math on the fly here. You could pay $10,000 for let's just do net value. So let's assume that the value is already out of it. You could pay $10,000 price, net value. You could pay $10,000 and you could get $50,000 of net value. Or you could pay $25,000 and you could get $100,000 of net value, right? So this is a 5x multiple. It's a 5 times return, right? You pay $10,000, you get $50,000 back in value. This one is only a 4x multiple. You're getting 4 times your money back. Which one should you choose? And the correct answer is this one, because you get more net value, twice as much, in fact, as this one. So even though you paid 2.5 times more, you got double the value, right? And so again, like the multiple is worse, but the total value is better, and that's all you care about, right? Would you rather have $500,000 more at the end after working with an advisor, or $1 million more after working with an advisor? Again, net after fees, even though you paid them more to do it. You should want the more money to help you out. Okay, so right, we are more expensive than some for sure, and even some of these, depending on what we're doing for you. And we're cheaper than others because we don't have layers and layers of fluff and middlemen and all that stuff in there. But it varies quite a lot because some people are just doing assets. Some people are cheaper on the assets because then they're also selling you a bunch of products that they make money on. We, at least in our firm, are doing planning, retirement planning, taxes and tax prep, tax planning, investment management, insurance advice, all those things, never selling you anything. So we are doing a lot more for the fees we charge. So we are definitely more expensive than discount people, but could we really do everything we're doing for a discount fee and still be doing a good job? I don't think so. Last way to think about it, right, is we said, hey, if we and them charge the same, we have the same price, who would you choose? And you say, well, we would choose you guys if you're the same price. Okay, why would you choose us? Well, because of this and that, taxes, etc. Okay, because so we're better. Right? If you're the same fee and you would definitely choose us, you're choosing us because we're better, and we're better, and that's why we charge more, because we're better at it. So I don't know if that is satisfactory. That's just kind of the way I think about it, and that might completely turn you off, or that might make a ton of sense. So again, in my mind, anytime you pay anyone, the value should be worth some multiple of that fee. And it's my job to show you as a client, as a potential client. It's anyone else's job to show you as well, hey, you are going to be better off after you work with us than before. And if you're evaluating multiple people, I don't know what they're going to do for you, but this is what we can do for you. And you'll have to decide, hey, are you also better off with us than anyone else? So that's another way to think about fees and value and price and all of that. Again, we're always super transparent on it. You always know your exact fee before you agree to work with us. And that way we can just, you know what you're getting, what you're paying, go home and sleep on it. and makes it really easy to evaluate us anyway. So yeah, if you want help, right, you're like, hey, I like all the tax stuff, I like investments, we like the way that you think about things, and you want some specific help and you don't want to DIY it, love to meet with you. Again, we meet twice for free, evaluate all your stuff, send you home, sleep on it. More of that. There's a link in the description if you want to schedule something like that. But hopefully it's been helpful to you. We'll be back next week again, every week, Wednesday, 4 p.m. Central. And would love to field some of your questions. So throw them in the chat, email them to us, questions@retirementship.com, and we'll see you next week. Thanks a lot. Cheers.